I'm so glad you're here to take control of your finances. Whether you're looking to create a budget, find out a little bit more about your financial options, or save for the future, this interactive session will give you the options and tools to achieve that. Let's get started on the journey together.
Thank you for joining us. My name is Kathleen Rushton. I'm AVP of Human Resources and Talent Development at Taunton Federal Credit Union. So I work in human resources, which involves a lot of training, and so my background is in training all of our lenders, all of our member service reps, and so while I'm not a lender, I do train all of our lenders at the organization. And I also have a certification in financial education. And so a lot of the information that I've gathered for our presentation today comes from our lenders at the organization and from different studies put out by the CFPB. So our focus today is on credit basics and debt management. The goal for today and the objectives are to understand the elements of a credit score, to understand how your credit score affects your credit worthiness, and to be able to understand how your credit impacts your budget. So a lot of time we start with a question about what is credit, and I think that term is simply explained by it's your ability to borrow from different financial institutions. You're always going to come across a situation in which you won't be able to pay for something out of your pocket, so you'll have to turn to a financial institution. It's a little bit of a catch-22 because you have to have credit in order to borrow, but it's a little bit difficult to build that credit, to start that credit to begin with. I always use the example of every day you're thrown opportunities to earn credit or build credit, and you may not realize it. A lot of people receive mail from credit card companies every single day offering them opportunities for credit cards. And some people don't realize the impact of applying for those credit cards, or lines at stores like Target, Kohl's, things like that. You're offered opportunities for credit, and people take advantage of that just to get the 10% off the purchase, but don't realize that impact it has actually on you. The CFPB did a study on how people can pay for emergency expenses and for a $500 emergency expense. And about 46% of the US population said that they wouldn't be able to pay for a $500 emergency expense out of pocket. So how would they pay for it? A significant amount of people would put it on their credit card over time. So 45% of those people would put it on a credit card, would borrow it, right? Or 29% would borrow from a family member, or just not be able to pay for the expense right now. So you think about people who medical expenses that they need right now. If they don't have health insurance and they're not able to pay for that emergency expense, they're just going to kick the can down the road, and things will get worse and things will get more expensive. Or say repairing their car, right? If you put it off further, that expense is just going to get more expensive over time. I like to start with what are the different types of credit, right? So what are the different ways you can borrow? We can see two different ways, such as unsecured and secured credit. Unsecured would mean that there's no collateral attached to that. So there's no vehicle, there's no home, versus secured, which would be something like an auto loan or a home loan. An example of unsecured credit would be a credit card, right? Or a student loan. So that means that if you default, meaning you don't pay for that loan, you don't pay them back, the bank is not going to be able to get their money back by pulling back the car, the vehicle, or the home. With secured, there could be a foreclosure, there could be a repossession, right? And that really goes into how that affects your interest rate as well. Secured loans have lower interest rates than unsecured loans because the financial institution is going to want to make their money somehow, right? So they'll get it in interest. There's also installment versus revolving, which really affects your budget. Installment would be that you clearly know how much you're paying every single month. Life of the loan is split up, and then each amount that you pay, monthly, bi-weekly, however you have it set up, is in equal amounts. So you know exactly what to expect. One difference would be home loans, where you have to take into account if you have something called escrow, like you have property taxes or home insurance to fall into that. Revolving would be that you're given a limit, And then you can spend up to that limit, pay it down, spend up to that limit, pay it down. And then, so thinking about that budget-wise, that's a little bit harder to manage. And an example would be a credit card or a home equity line of credit, which is just like a gigantic credit card, but it's held against your home. When we talk about credit score, so your ability to borrow any of those things, installment loans, revolving loans, unsecured, secured, your ability to borrow, a lender is looking at all sorts of things. So the credit score is determined by a lot of different factors, and we're going to go into that. But that's only one part of what a lender is looking at. A lender is looking at that score. Somebody might have a 780 credit score, but that's not the whole picture of them as a borrower. Another thing that the lender looks at is capacity. So that is, how able are they to take on another loan, right? How close are they to potentially reaching bankruptcy, right? So if somebody has 10 credit cards out and they're all maxed out, a lender, and then they're applying for another unsecured loan, meaning another credit card or a personal loan, the lender might think that's not really a great idea to add that loan onto it, because they could be putting themselves in a position where they will default on not just one, but all of their loans. Character is lenders, especially, we have lenders who've been lending for 25 years. They've seen the market go up and down. And they also, especially being a credit union, we know our members, right? So we have people who have borrowed from us and not paid anybody back, but they pay us back, right? So we have that history with them. So the lender is also looking at that. And they know kind of, just from looking at history of people borrowing, they know sort of when people are approaching that kind of dangerous level of taking on another loan. Another thing is collateral. Lenders are more likely to lend for a loan that has collateral, so something that we could potentially take back. And I'm not saying we want to take things back, because we don't, but that is one way of, if somebody does default, that we can recoup the cost of the loan, right? Another thing is condition, and this is something that people who are borrowing have no control over. This is what's happening in the economy, or based on the lending that the organization has done. Have they reached their cap for the year? Because all financial institutions have sort of caps based on how, to stay stable, they can only lend so much. So that has nothing to do with the person who's asking for the loan. It has everything to do with the economy and the financial institution. I think a lot of people take a look at their credit score when they, credit card companies offer the opportunity to look at your credit score online, but they don't necessarily know exactly where that number comes from. It's proprietary information, how FICO is calculated, and sometimes you're looking at those different credit bureaus and you're not really understanding why one is so different from the other, and it depends on which version of FICO they're using. So while we may not know the formula, we do know what affects your credit score. So what can have the greatest effect? So really, when you look at the greatest effect, it is payment history. So on-time payment history. So I'll use myself for example. I've had a student loan since I was in college, and I've been making on-time payments every single month, and that's been going on for at least 15 years. So when you're looking back at that, that's going to have a positive impact on my credit score. If I'm not making those payments, that's going to have a negative effect, and it's going to have a large effect on my credit score. Another thing would be amounts owed. So when you're looking at those credit cards, a lot of people, especially right now, are maxed out on their credit cards. So they have, and every time you spend on your credit card and you reach that max limit, a lot of times they'll send you sort of a survey asking what your current salary is, and then they'll bump up your limit. So they're giving you even more opportunities to owe more money to them. So that's a huge effect on your credit score, how much you owe. Another thing is length of credit history. So I think about the time I applied for auto loan when I was fresh out of college, and I didn't have any payment history. So my credit score was 0. There was nothing there. There's no history there. And so that's going to affect what kind of interest rate you receive. And I think my interest rate was 14% on a vehicle at that point. Types of credit, they want to see a variety of credit. So they want to see, do you own a home? Do you have a vehicle? Do you have an unsecured loan? And that variety of loans is going to have a positive impact on your credit score. So how can you positively impact your credit score? And I think just based on the previous information I gave, making payments on time. I know sometimes it may be difficult to balance all those payments, and some people want to pay off their loans. We'll talk about why paying off your loan is not necessarily a good thing, but making those payments on time, even if it's the minimum payment on installment loans, is going to be beneficial for you. Another thing you can do to positively impact your credit score is something that I think there's old information out there about, which is keeping your unused credit cards open. I think a lot of people think that if you're not using a credit card, you should close it. I think, you do want to use your credit cards and you want to keep them open, because as soon as you close a credit card, it's going to immediately have a negative impact on your credit score. It's going to show that you have less available credit to use. And this is the part that's a little bit confusing, is that financial institutions want to see that you have credit available to you and you're not using it. Right? So you have a credit card with this limit and you're not maxed out. You have all this limit available to you, but you're not using it, right? So that shows that you're maybe in a more financial stable situation, which I know if I'm applying for credit, I need credit. But at the same time, financial institutions have a responsibility not to put you in a bad financial situation. So use your credit cards, use them and then pay them off. But keep them open, because as soon as you close them, that's when your credit score can show a drop, especially if you're somebody who's going to be applying for credit pretty soon. So you're applying for a home loan or you're applying for an auto loan. That's going to have a negative impact on your score. I know it's hard to say have a variety of credit available when you're just starting out. A lot of times people go to a credit card first. Store credit cards, I just want to give a little bit of a warning about that with interest rates. I've seen them right now up to 35% interest rate, which is huge. And credit unions, just for your knowledge, all credit unions, regulatory, we're capped at 18%. So our credit cards cannot go above 18%, which compared to when you go to stores or when you get your first credit card, a lot of times those interest rates are astronomical right now. And then limit the number of hard inquiries. So you may not realize it, but your credit score, people are constantly pulling your credit. So every time you get that mail of those offers of credit cards, they're doing what are called soft inquiries. So they're checking to see if you might be suitable for this credit card, and then they're sending it out. It's not going to have an impact on your credit score, but it is an inquiry on your credit. Same with insurance companies. You may not realize it, but your insurance company, for your auto insurance, they're pulling your credit to make sure that and that affects your actual rate that you pay for your car insurance. So you want to limit hard inquiries. Credit bureaus do know that if you're shopping for a car, there is going to be a period of time when you're shopping and there's going to be more inquiries. People don't realize when they go to a car dealership, that car dealership is, as soon as you sign that paper saying you're looking for financing, they're sending that out to all of the financial institutions they have connections with. And so that's going to be a hard inquiry. It depends on the dealership, but that could be 7 times on your credit that they're pulling. Some will work with you if you can go to your financial institution and apply for credit first there, and then bring the information to a dealership. You can always at any time pull your credit or look at your credit by reaching out to the bureau. Some of them, it does cost money. So the 3 bureaus are Equifax, TransUnion, and Experian. Financial institutions that are offering loans, they might use 1, they might use 2. I will say that we use Experian, and I do know a lot of financial institutions that use TransUnion. I wouldn't recommend using something like Credit Karma. Credit Karma does an aggregate of all of those credit bureaus, and it can be a little bit frustrating looking from day to day at the change and maybe not an accurate picture, as well as there are a lot of offers of predatory lending through that app, such as payday loans, things like that. You can always go to freeannualcreditreport.com and get your credit as well. And a lot of times when you have a credit card, they offer you updates every month or every statement period on your credit report. I have this little graph just to show the effect of your credit score on what you actually pay in interest for a loan. So these are lower APRs, annual percentage rates. These are now I'm thinking about more of like an auto loan, right? And right now, a lot of starting base rates for a 720 score would be something like 6%. So we're looking though at the lowest, right? If a monthly payment was $563, the total interest over the life of the loan you're paying is $2,017 versus somebody who is at a lower score, such as a 500 score, they're paying 14%, and monthly they're paying $691. So it's a greater effect on your budget monthly, and then over the life of the loan you're paying $8,157. So that's a significant effect on your pocket, on your budget, on how effectively you can pay off the loan. So improving your credit has a direct correlation to what you end up paying in the end. I have this other graph which is a little bit older, but it shows with credit cards, the effect of carrying a balance on your credit card. I think what happens a lot of times is that people use their credit card for, say, holidays or expenses that they might not have in their account. They might not have the funds in their account, right? And so because they don't have it in their account, then they can't pay off the balance at the end of it, end of the statement period. So if you're carrying a $5,000 balance, right, and then you're paying the minimum amount that's required, that could take up to, in this example, 14 years and 7 months to pay off $5,000. Versus if you're paying a little bit extra every single month, you're going to shorten the life of how long it takes. So there are a couple warning signs of poor debt management. One is that payments start getting missed. And remember, from the very beginning, we talked about the effect of missing payments, how that can affect your credit score, right? Besides that, interest is always accruing. Interest accrues daily. So you want to make on-time payments so that you're not paying more in interest. Checks start to bounce and overdraft is used frequently. The average overdraft fee is $30 to $35. So people, may not be paying attention to what's available in their account, swiping their card, causing overdrafts, and that can build up. And you think about a $3 cup of coffee now costing $33. People start going into the grace period. So for the first 15 days, so you have a due date, and for the first 15 days, that's considered the grace period to make the payment. After that, you get hit with a late fee. And again, like I said, that interest is accruing daily. So if you're going into that, you're pushing it, and you're paying more in interest in the end. And then if you realize you're pushing it, you might continue to push it to the point where you become delinquent on that. At or near limit on credit cards, that's a sign of poor debt management because you're not able to pay the minimum, the balance every month. And it's that interest, like we said, that 35% interest, that's just going to it's hard to keep up with that. And again, that credit card payment's not paying at least the amount owed. So there are different ways to prioritize debt management. This is the last topic we'll talk about. If you get to the point where your credit score is suffering, you're really at limit on credit cards, and you're struggling to budget. So there's the snowball method and the avalanche method. So the snowball method would be to split up and maybe make smaller extra payments to all of your loans, right? An avalanche payment would be to focus mostly on those high interest loans and pay, if you can pay even just a little bit extra, even if it's $5 extra, and really focus on bringing down those high interest rate loans. And it's different things work for different people, and it's all about what you can manage in your budget. And Dora from the United Way can sit with you and go over your credit report and come up with a strategy to effectively manage your debt. And that's all I have for today. Thank you for watching.
Thank you for joining us today. I encourage you to schedule a one-on-one check-in with me for personalized assistance. Whether you reach out through phone, text, or email, I'll be happy to help. Together we can help you achieve financial wellness and create a strong foundation for your future. Until next time, keep growing, keep learning, and keep thriving financially. See you soon.